Ever notice how major price moves in crypto always seem to happen right after you buy or right before you sell? That's not just bad luck. It's the result of timing. And the ones timing it best are the whales, the biggest and smartest players in the market. These are early investors, institutions, and funds who move millions, sometimes billions of dollars quietly, long before the average trader even realizes what's happening. When they buy, they accumulate strategically, often across multiple wallets to stay hidden. When they sell, they do it in stages to avoid alerting retail traders too soon. The reality is, whales move first, and the rest of the market follows. What looks like sudden price action to most traders is often the result of whale positioning that happened days or even weeks earlier. The beauty of blockchain, though, is that it's fully transparent. Every single move a whale makes is recorded on-chain, if you know how to read it. In this video, we'll break down exactly how to track those wallets, interpret their movements, and spot trends before retail investors even know what's coming. Because in crypto, knowing what the whales are doing isn't guessing. It's reading the future written in data. One of crypto's biggest paradoxes is that it's supposed to be the most transparent market in the world. Every transaction, every wallet, and every token transfer is visible on chain. Yet most retail traders are still blind to what's really happening. The reason? Information asymmetry. Big players, institutional funds, market makers, and long-term crypto insiders use sophisticated on-chain analytics tools to detect accumulation, rotation, and profit-taking long before any headlines or tweets start circulating. Meanwhile, retail traders rely on social media hype, influencer signals, and price charts, all of which lag behind real on-chain activity. Whales, on the other hand, are already positioning themselves quietly. They accumulate when prices are boring and sentiment is low, and they distribute when everyone else starts getting excited. Take recent examples. Before the meme coin Pepe exploded in 2023, a handful of known smart money wallets were accumulating billions of tokens days before it trended on Twitter. Similarly, during AAVE's early DeFi boom, whale wallets began adding liquidity and locking tokens weeks before the price breakout. And in Solana's 2023 comeback, on-chain data showed massive inflows into Solana staking pools, a signal of whale conviction, while retail sentiment was still negative. These patterns show one clear truth. The crypto market rewards those who watch behavior, not headlines. The signals are right there on the blockchain, free for anyone to see, but only those who take the time to understand them can move with the smart money instead of chasing it. Before you can follow the whales, you need to understand who they are, because not all large wallets mean the same thing. In crypto, a whale generally refers to any entity holding a significant amount of tokens, often enough to influence prices if they decide to buy or sell. But within that definition, there are several important types, each leaving a different footprint on-chain. First, there are exchange wallets, which belong to platforms like Binance, Coinbase, or Kraken. These hold funds on behalf of millions of users, so a large movement here doesn't necessarily mean one whale is buying or selling. It might just be regular user activity. However, when you see a big inflow to an exchange wallet, that can be a bearish signal. Whales might be moving assets there to sell. Conversely, exchange outflows often suggest accumulation, as investors move coins to cold storage to hold long-term. Next, we have institutional or fund wallets, managed by hedge funds, venture firms, or DAOs. These wallets tend to show structured patterns, steady inflows during accumulation phases, smaller test transactions before major buys, and diversification across multiple assets. For example, during Ethereum's transition to proof of stake, several institutional wallets increased their ETH holdings significantly months before the merge, anticipating higher long-term demand. Then there are smart money wallets, a term often used for addresses with a proven record of profitable moves. On platforms like Nansen or Arkham, these wallets are labeled and tracked for their accuracy. For instance, wallets that bought early into Uniswap, AAVE, or Layer 2 tokens before their major rallies. These are the addresses retail investors love to monitor because they represent informed conviction, not random speculation. Finally, there are project or insider wallets belonging to developers, teams, or treasuries. Their activity can signal upcoming unlocks, vesting releases, or sell pressure. When these wallets start transferring large amounts to exchanges, it's often a warning that token supply is about to increase. So reading whale wallets isn't just about watching big transfers. It's about understanding context. Who's moving the funds? Where are they going? And what's the broader market condition? Once you learn to categorize whale activity, you stop reacting to noise and start decoding the narrative behind the numbers. Once you understand what types of whale wallets exist, the next step is knowing where to find and track them. The good news? Every single whale movement is public. It's all recorded permanently on the blockchain. The challenge is filtering that endless stream of transactions into actionable insights. That's where specialized tools come in. At the most basic level, platforms like Etherscan or BSCE Scan let you search any wallet address and view its full transaction history. You can see how much ETH, stablecoins, or tokens it holds when it moved them, and even which smart contracts it interacted with. For example, if a large wallet suddenly swaps millions of USDC for ETH on Uniswap, that could signal early accumulation before a market move. The problem is, Etherscan gives you raw data, useful but not yet meaningful without analysis. That's where professional-grade analytics platforms like Nansen.ai, Arkham Intelligence, and Whale Alert come in. Nansen.ai is known for labeling wallets, identifying smart money, venture capital funds and exchange addresses, and showing live inflows and outflows. For instance, before the Lido LDO rally in 2023, Nansen data showed a spike in ETH deposits from whale wallets into Lido staking contracts, hinting at rising confidence long before retail traders caught on. Arkham Intelligence goes deeper, linking wallet clusters to real-world entities such as exchanges, funds, or even known traders. This lets you distinguish between a genuine whale move and just an internal transfer. Whale Alert, popular on Twitter and Telegram, provides real-time updates of large transfers, like 10,000 BTC moved from Coinbase to an unknown wallet. While it's not analytical, it's a great way to spot sudden spikes in big transactions that might warrant deeper digging. Beyond these, there are also Glassnode, Santiment, and CryptoQuant, which track exchange inflows, miner reserves, and network activity, giving a broader macro picture of whale sentiment across entire ecosystems. The key is not to chase every transaction, but to recognize patterns, repeated inflows to certain protocols, coordinated exchange withdrawals, or smart money accumulating the same token across multiple wallets. Each of these tells a story about where capital is quietly moving before retail hype begins. In essence, these tools turn blockchain data into market intelligence. While retail traders wait for news, those who study whale flows are already preparing for what comes next. Tracking wallets is just the first step. The real edge comes from interpreting behavior. Whales rarely act impulsively. Their moves follow recognizable patterns that reveal what phase of the market they're preparing for: accumulation, distribution, or rotation. In the accumulation phase, whales quietly build positions when prices are low and sentiment is negative. You'll often see consistent, moderate-sized purchases spread across multiple wallets instead of one large buy, a strategy to avoid drawing attention. Exchange outflows usually increase during this time, meaning coins are being withdrawn to private wallets or cold storage. A clear example occurred in late 2022, when Bitcoin was trading around $16,000 to $18,000. On-chain data showed a surge in outflows from exchanges and large addresses, steadily adding BTC, months before the recovery to $30,000 began. Then comes the distribution phase, when whales start offloading positions as retail enthusiasm grows. This is often marked by rising exchange inflows, whales sending tokens back to exchanges to sell into demand. You might also notice smaller feeder wallets receiving transfers from main whale addresses to split sales across multiple exchanges. For instance, before the May 2021 Bitcoin crash, exchange inflows from large wallets spiked sharply, a clear signal that whales were preparing to take profits while retail was still buying. A third behavior pattern is rotation, where whales shift capital from one ecosystem to another rather than exiting the market completely. For example, during the 2023 rotation, several smart money wallets moved funds out of DeFi governance tokens like UNI and AAVE and into Layer 2 projects such as Arbitrum ARB and Optimism OP. The rotation signaled where the next narrative, in capital flow, was heading. Another subtle indicator is on-chain clustering, where multiple unrelated whale wallets start interacting with the same protocol or token around the same time. This often precedes strong upward moves. A good example is Solana's 2023 rally, where whales began staking and accumulating SOL aggressively between $18 to $25, while social sentiment was still negative. Within months, SOL had tripled. While whale tracking can reveal powerful insights, it's easy to misread the signals. Not every big transaction means a buy or sell. Sometimes transfers are just exchange reshuffling, cold wallet migrations, or liquidity movements by market makers. For example, when Binance moves large BTC batches between internal wallets, it can look like a whale dumping, but it's often just operational. Another common mistake is blindly copying whales without context. A smart money wallet might sell a token not because it's bearish, but to rebalance risk or rotate into another opportunity. Without understanding the bigger picture, like upcoming token unlocks, ecosystem changes, or macro trends, following whale moves alone can lead to false signals. The goal isn't to mimic whales, it's to decode their intent. Look for patterns that repeat. Multiple whales buying the same asset quietly, or steady outflows from exchanges when sentiment is low. That's when the data tells a real story. In crypto, information is power, and whale wallets are the purest form of it. By learning how to read their moves, you're not guessing where the market's going. You're watching the smart money make its next play. Remember, whales don't chase trends, they create them. The question is, will you keep reacting to the market or start reading it before everyone else does?